let's talk now a little bit about your guide to retiring early.
There's a lot of pent-up savings from the pandemic. It's still ongoing, and there's a lot of clients out there who need to put it to work.
Where you have that little bit extra that maybe you weren't expecting to have, get it into your pension, and it's quite rewarding to see, you're getting closer to your goal.
Constantly assessing and monitoring that goal. Are you ahead? Are you behind?
The platform team. Don't forget, everybody, as well, that tax relief is a hugely important part of investing. Hi everybody, and welcome to podcast number 81, Your Guide to Retiring Early. My name's Steve Hutton, and I have the pleasure of hosting today's podcast, which is a first for me. I'm normally the one answering questions, so it's poacher turned gamekeeper today. I'm joined on the podcast today by Jenny Hall, Phil Elvin and Chris Leyland, and we're going to have the normal process of a market update, and then we're going to talk about the topic and hopefully give you some insight as to how we think you can enhance your retirement and maybe, if you get lucky, retire early. So to get things off, Chris, can I ask you to give us a quick market update?
Yeah, absolutely. Thanks, Steve. I guess, just thinking about equity markets over the month and over the week, in general, what you've seen is pretty positive returns, actually. The UK's up around about 1% this week, similar over the month. If you look at Europe, positive returns over the week, but then you've got France and Italy up around about 5% over the month, which is great. But the US up around about 2% over the month and up around about 1% this week. I guess what have been the sort of key drivers there? I think what you're seeing are more investors just concentrating on the recovery overall. And also, as well as that, you've had some strong jobs data come out in the US. So you had jobs data come out last Friday. Also, jobs data come out earlier in the week, actually better than expectations, and just really illustrating the US economy basically going back to normal, or as normal as it can be. I mean, there's 6 million people unemployed, more than February 2020. But if you compare that to a few months ago, that number was 10 million. So more and more people are going back to work in the US, and we're returning to that normality overall. I guess just a couple of stories from me. I guess probably one of the big key events this week was the passing of the $1 trillion bipartisan infrastructure bill in the US. So the Senate, which is equally split between the Democrats and the Republicans, voted 69-30 in favour of the bill. So firstly, it's a real positive to see two political parties coming together to overcome issues. If we look at what does it mean, so basically the bill will disperse $550 billion in new federal spending over the next 5 years. So that's going to go on upgrading America's roads, bridges and tunnels, airports, rail networks, and the power grid overall. And also, as well as that, it's going to target clean energy and provide high-speed internet. So I think the bill's a big positive. I'll be very honest with you, there was an expectation of this coming through, so you haven't seen a huge move in asset prices overall, but it's still good that we're actually starting to see parties coming together to basically put this together. I guess the second thing is probably something a little bit closer to home, which is UK GDP. So you saw Britain's economy surge forward in the second quarter, so it grew 4.8%. And what you've seen is obviously consumers eagerly spending money following the easing of coronavirus restrictions, the progress of the vaccination program overall. So what it's done is it's allowed the economy to recover a lot of the ground that was lost over the past 2 years. What I would say is it's in line with market expectations. I think you had Rishi Sunak saying that it was evidence, in his words, that the UK economy is bouncing back. And if you look into that, and this probably won't come as a surprise to any of us in this room, but the key things that have been doing very well is a big resurgent spending on restaurants, hotels and transport. So again, what you're seeing is a sort of path back to normality, a path away from COVID, all the things that we've been probably quite used to at the moment, and just moving back to consuming, which is great.
Interesting you say bouncing back, Chris. I'm from Bradford, and our football team in the 80s had their logo on their shirts, and it was Bradford's bouncing back with a big thumbs up, which reminds me of our Prime Minister, always Bradford's bouncing back, but it never
Maybe
did.
that's where he took it from.
Perhaps. A couple of things for me on that, Chris, and
Yeah.
again, as a novice bystander just watching the markets, things that seem to be happening is it seemed a lot quieter on the volatility front last week, which is reassuring, I think, to investors. And also the inflation numbers coming out of the States, were they... The talk that I read on I'm sort of looking what the BBC sort of puts on their front page, was the fact that this inflation level that we've got at the minute is temporary, and that seems to be the mantra coming through from the government. So what are your comments?
Yeah, no, the good observations actually. I think first, if we take volatility, you're right. I do think if you look at something like the VIX, which is a measure of volatility around the US index, that's been fairly subdued. So you've seen volatility come down overall. I think overall what you're seeing is investors just thinking about the future and thinking more around that global reopening story, thinking around the global economy reopening, rather than focusing in on what were the issues, potentially focusing on things like the Delta variant, but also, inflation as well. And obviously one of the key things that we've been talking about on the podcast and all the kind of media stuff that we do is really around inflation. So you had the US CPI print come out on Wednesday. It was 5.4% year on year. But one of the key things is when you actually look at the monthly expansion, that's actually really pared back. And actually a lot of the big things that were in the inflation print that people were quite nervous about have actually come back down. So remember things like used car prices in the US, I think last month were up something like, I think it was about 30-40% over the year. Now what you've seen is all that be pared back. So what that shows to me is that the higher inflation prints that we're seeing are transitory. And that's actually what it's shown the market, and it's what it's shown investors. And a lot of that is why you've seen investors be a lot calmer over the week, because they're starting to say, okay, actually, do you know what? We know there's going to be higher inflation. And the reason for that is because you saw that cratering of prices last year due to the pandemic. You saw the oil price go negative, which is incredible. But then the reality is that it is due to the pandemic. And actually the view is, and this is our view as well, is that it is transitory. So we won't be seeing hyperinflation or anything like that. Inflation may be higher than what we've seen in the past, but you've got to remember that inflation has been incredibly low pre-pandemic. But the reality is that we'll move back down to a more normal level, move back down to a level that's more in line with central banks' targets overall. So I think just in summary, you're exactly right. I think investors are just in some ways becoming more comfortable with the economic data that's coming out. I think the issues that are out there, they're starting to be fixed in reality.
Great. Well, to a Yorkshireman being told that I'm right, Chris, is great.
Yeah, well done.
Especially when I do recognize that I'm wrong most of the time, but there you go. Talking about used car prices, Phil, I mean, Phil's our head of sales. You have a reputation for liking to sell cars as well. What are we seeing through our advisor base at the minute? Are they quiet at the moment? How are they looking at the markets and investing, and how are they helping their clients? And I'll ask Jenny that same question in a minute, because obviously she sees clients from direct line, if you like.
On the advisor front, it's fairly busy actually. I think there's a lot of pent up savings from the pandemic. It's still ongoing, and there's a lot of clients out there who need to put it to work. So they're reaching out to advisors, and obviously advisors are ever keen to help them. So we've seen brilliant sales flows the past 2-3 months. That's continued in August. It's been strong, which historically it is one of the weaker months in the year if you look at sales. But we've had a good showing this month, and I think that's due to some of the factors that you mentioned, especially regarding the UK. I think we're all set. It's fairly positive at the minute, which is good.
Brilliant. And Jenny, we've had a lot of volatility in the market, and you're at the sharp end, if you don't mind me saying, because you and your team are dealing with our clients every day. How are you seeing increased client activity, or are you finding now that as markets have calmed down a bit, the clients are really calm and listening to what we're saying and to keep calm and stay in their seats?
Yeah, absolutely. I think if we, rewind probably about 14 months to kind of when the pandemic came about, we were seeing a lot of, not just volatility in the market, but volatility with clients thinking, I've got to get out, I need to get out. And, as the prices continue to drop, people that took out and, liquidated to cash, opposed to people who stayed invested, seen a lot of there was a massive difference. So those people that rode it out actually, you know, are probably better off now than those people that liquidated. But yeah, we've absolutely seen, you know, it's a lot calmer, should I say. But I think the main thing that I'm noticing now, or that we as a team are noticing, that following the new tax year, and now that restrictions are lifted, you know, people are wanting to do stuff because we can. So we have kind of seen an increase in withdrawals being made. And, you know, that's probably because people have not been withdrawn for, you know, the last kind of 14, 15 months where they've not needed to, and where they've had nothing to do. There's been, you know, nowhere to go, nobody to see. But now, you know, kind of restrictions are easing. People are wanting to get back, as you said, Chris, to some form of normal life.
Interesting.
So,
And markets are now higher than they were. So if people had
They
pulled
are,
out,
yeah.
they would have made a mistake. So hopefully they haven't. But
Yeah, no, it's a good thing actually. We were actually looking at this yesterday, and we were looking at how the market has moved basically since, I think it was February the 20th, 2020. That was the kind of start of the big fall that you saw in equity markets. So if you track that to today, you're looking, if you look at MSCI World, so that's the world stock market, and this is in dollars, you're looking at, it's up around about 14%. So obviously you've had that drop off, but now you've gone above that. And I think, you know, the key thing, and this isn't just for, you know, a pandemic, this really is all the time. And, you know, hopefully people who are watching this, you know, one of the things that really need to take away is that you need to stay invested. It's the most important thing that you can do. You know, as soon as you start to panic to take money out, basically you're now the fund manager, and you're also the fund manager that's making the biggest decision that you can make. You know, the reality is, you know, we did see clients who were considering pulling money out, and some did, and the reality is they've lost out on that uplift.
yeah.
You know, you have to stay invested. Just ride it out. The reality is, over the long term, equity markets trend upwards, but at times there will be short-term volatility. We all know that, whether it be a pandemic, whether it be something else, but the key is to stay invested.
yeah, I mean, that's a beautiful, seamless link into today's
It
topic.
is, yeah, it's weird, isn't it?
Yeah, really helpful of me to get it back
Well
on
done,
track.
Chris.
So, let's talk now a little bit about your guide to retiring early. Now, it might not be something everybody wants to do. And looking around the room as somebody who's nearer retirement, not there yet, but nearer retirement than most of you, the thought for myself of going into retirement is quite frightening. You know, what would I do all day? I was actually thinking about it last night. What would I do all day if I was retired? So suggestions on a postcard, please, in typical Blue Peter fashion to True Potential. Yeah, but let's talk about how you start if you want to look at your sort of path to retirement. And we're going to talk to our younger members first. Chris, beg your pardon, you are younger too, but there are slightly younger. Presumably then, lady and gentlemen, it's about setting a goal. It's about getting into view what you want to do. So if you're thinking sort of 55 as being an age when you can legitimately think seriously about retiring early, presumably, Phil, then you've got to get your goals aligned. And how do we do that? Do we make it easy for clients? How do we facilitate that journey, if you like?
Yeah, so you rightly said the key thing is setting a goal in terms of how much you want and, excuse me, by when. Typically, your advisor, if you're a client of True Potential, will work with you on that goal, and the whole system is goals-based investing. That's everything we do here is about goals-based investing. There's a long chat that will occur there where you set out what the goal is, how, you know, when you want to reach it and by how much, and really the rest of the investment pathway for a pension, especially, is just constantly assessing and monitoring that goal. Are you ahead? Are you behind? How to make contributions, etc. And it seems daunting. It's not a case of just putting, you know, a lump sum of £20,000 down in a pension at day one and just kind of letting it work. I've written down here regular contributions. That's the key. We've talked about the past 18, 24 months. Regular contributions are more important than ever at that point. You get benefit from a bit of pound cost averaging, and it makes it less difficult on the bank balance if you do that. But that's the key. Just little and often, and time is the ultimate factor in reaching a goal, because typically if you're younger you've got more time than some older people. on that macabre note.
And again, you're very right there that the earlier you can start as well,
Yeah.
you've got longer time for your money to grow. Jenny, give us some indication, because we're always talking about using tax allowances. Give us some indication how busy you get. And this is sort of for people who don't use their tax allowances. You might be missing out because other people are. What sort of volumes do we get? How busy are you at? I'm leading you on here a bit, so apologies. How busy are you at tax year end?
The tax year end, so probably the start of March to probably, I would say mid-May is one of our busiest times on platform. And not just for clients, putting in, it is also for clients, wanting to use their allowance to take out as well. But touching on, clients putting money in, the number of impulse saves that we see around that time of year is it's astronomical. It's huge. I think, on average, it probably increases by about 20 million each month. So it's a brilliant way to put your allowance in if you've forgotten, if your advisor can't manage to get around, or if you don't have a checkbook, because in all honesty, I don't have a checkbook. I've never had one. I don't know whether it's a generational thing, but my mum still writes checks out for everything. But impulse save's a great way, in addition to adding money to your pension or ISAs, anything like that, as well as those regular contributions. So where you have that little bit extra that maybe you weren't expecting to have, get it into your pension, and it's quite rewarding to see you're getting closer to your goal. And my goal's way off, because I've got quite a few more years to go yet. That's if I ever retire. But yeah, I guess it's just, tax year end is crazy for us with contributions going in.
The checkbook debate is a good one. Even I don't use a checkbook or have a checkbook anymore, and that's interesting, isn't it? Phil, how easy is it to make just talk us about the logistics of making an impulse save, because Jenny has referred to this superb facility we have that a lot of other companies that take people's investments don't have. They're still probably trying to do things paper-based. Tell us how we facilitate digital investing.
Well, you can do it on your phone. That's the main route of impulse saves we see now is through your phone. It's about 4 or 5 clicks. It takes 2 minutes once you've got your card set up there. It's a case of literally opening the app, go in and choosing an amount to put in, whether that amount's £1, £10,000, or however much you can afford. That really is the key. And just to key into what Jenny was saying there, what we've noticed in tax year end numbers, obviously the numbers of clients we have now and the savings that they're making is huge compared to what it might have been 5, 6, 7 years ago. But that peak is beginning to flatten somewhat throughout the year, in so much that the behaviour of advisors speaking to their clients to say, look, the allowance is an annual thing. You don't just need to do it in March and then the new one in April. You've got all year to use it. So again, going back to doing it regularly, don't just if you're using your ISA allowance, don't put £20,000 in at the end of March and then another £20,000 in at the start of April. You can split that up over the year.
That would be preferable for platform as well, so we don't have a magnitude of requests.
I knew that you would buy into that, which
one.
is why I said it. But look, a quick way of doing it and an easy way of doing it, as we've said, is impulse save. You can set reminders to do it. You can set direct debit up as well if you don't want to do an impulse save, or to complement an impulse save. There are many ways to do it, and it will help Jenny.
Yes, and my team. I know everyone on platform.
Well, if we achieve nothing else today, that would be great. We can help the platform team. Don't forget, everybody, as well, that tax relief is a hugely important part of investing. Both if you're investing in funds that are tax-free, such as pension funds, but equally on the way in. And basic rate tax relief on a pension, we will actually claim back for you. Yes. We will go to the revenue and get that back for you. So that's 20% straight away. Nice, and it's probably increased from that now since I was on it.
I think it's 23.
Oh gosh, right, it's going up as we speak.
Oh no, I'm questioning myself now. Is it 20%? Is it 25%?
But we claim that back directly, so you don't even have to worry about that. And if we go up to the higher rates of 40 and 45, you get that back by your tax return. So if I were to suggest to you, Chris, I've got an investment that will guarantee you 45% in the first year, you'd think I'm crazy.
I'd probably be very nervous. I'd be checking out, is this authorised by the FCA?
Yeah, I seamlessly again gave you the option to call me crazy then, but thank you very much. In polite manner, you chose not to do it.
Very well.
Yeah, and the other thing I think we should talk about is taking emotion out of saving, isn't it? Because I think last year we're lucky in the sense that we lived through last year and the dip that we saw, our emotions were tested at the time of the correction, if you like, or the dip. Did we I mean, our message, Jenny, from the sales team was stay invested. We were quick to get messages out from the investment team and yourselves out to all our clients and our advisors. Do you think that worked? Do you think we got our message across that people? Great.
Yeah, I absolutely think we did. There was a lot of, and I appreciate probably the position advisors were in at the time, with all of their clients contacting them, trying to speak to everyone, trying to reassure everyone. So I think, the communications that we put out, the podcasts, the morning market videos, I think that really helped to reassure clients that not only were we trying to communicate and let them know what we were doing from, an investment perspective, but, it was kind of a constant thing there that, they could watch, that they could check in with, as opposed to, having to get on the phone to their advisor every day, because if an advisor's got 50 clients, say for example, imagine having to speak to 50 clients every day during a pandemic. It's just nightmare. Yeah. So
no, that's brilliant. I'm glad we got the message across, because we've been saying it for years. I'm long in the tooth in the industry, and each time these things happen, people react emotionally and they react after the event. So it's a double whammy of you're letting your emotions drive your actions, which is great in our social lives. Our emotions make us attractive and make us Yorkshire people, but beyond that they become very punitive to your savings if you get. So I think a quick recap on the start is set a goal, make it realistic, get it in view, use the technology, use impulse save and digital means, not use your old-fashioned checkbook, but once you're set on that goal, then it's a case of not giving into your emotions and sticking with it. Keep the course, as it were, stay the course and keep going. Okay, let's look a bit further down the line now, and let's look to an age at which you can retire. So 55 is, let's take that as a standard age that you could start to take your pension benefits. Phil, I'll go to you first on this. Is it wise to start taking your pension benefits as soon as you can? That used to be the mantra when I was younger. If you can get your hands on your pension, you should take it. I think that's changed a little bit now, hasn't it?
Well, it has. My advice would be, just because you can doesn't necessarily mean you should. If you can afford not to raid the pension pot, as it were, don't do it. We've talked about in previous episodes how good the pension vehicle, it's a wrapper, is for tax, inheritance tax planning, and so on and so forth. If you can afford to take the bare minimum out of that product, then that's what you should do. In addition to that, if you've got other wrappers, ISAs, you might have a GIA, for example. If you need an income from all of your retirement pots, you should be looking at other wrappers first and try and preserve the pension for as long as possible. And if you do need to take some money from your pension, I wouldn't necessarily go in there for the full 25% tax-free cash. I think taking an income is something that we talk about fairly regularly. We were talking about it earlier this morning. That would be my suggestion. Take as little as you can, but if you need to take something, take a realistic income out of your pension to preserve the money in there.
I think one thing I find quite fascinating actually is, obviously people can take up to 25% tax-free cash, and it's really important to say you can take up to 25%. But quite often you do see some clients, certainly in the previous places that I've worked, who have taken that 25% and they've taken it as cash. And you always would have said to them, well, okay, so what are you going to do with the cash? They say, well, I'll spend some of it, but I'm going to keep it as cash. So, well, why are you taking it out of the tax shielded wrapper that is earning a return? And you say, well, because I can take 25% tax-free cash, but you're not earning a return on it. One of the big things on cash is that basically the return is zero. A real return is negative, so a return after inflation is negative. So for me, just building on what Phil said, the reality is if you don't need that money, don't take it out. Keep it shielded within the tax wrapper. Watch that money grow, and then if you need to take more money out at a later date, that's absolutely fine if you need it, but only if you need it. Let that money grow overall. Let that money beat inflation, above inflation.
That's an excellent point, and I think when we talk about the digital society that we now live in the olden days, it used to be quite a process to get your money out of your pension. You'd have to write a letter, you'd probably then get some forms, you'd have to fill in and get witnessed and send back. And I think that played into some people's insecurity. Thought, I better take a big amount of cash out of my pension, so I've got some in case it takes me 3 months to get my money out. it's instant these days. It's a lot quicker. Jenny, you can take us through how instant and how quickly, and some of the cost advantages of being a true potential client versus the rest of the market, and when it comes to time to try and take some of your money out of your pension fund.
Yeah, absolutely. I think one of the great things about, again, coming back to technology and what options you've got on the client side is that you do have the option, come your retirement age or 55 if we're saying, that you can activate the button, or there's a take benefit button on your client site. You can click that, you can go through the questionnaire that I think it's about 15 questions, and it'll ask you what you want to take, whether it's income, whether it's tax-free cash, and you can then submit that to us. It probably takes about 10 minutes all in all. It's received to us, and we can process it pretty much the following day. So it's very, very quick from you actually telling us you want the money, and more so you can do it electronically as opposed to having to wait for us to receive something in the post, wait for a telephone call to go through it with a member of staff. And yeah, all in all, the process from requesting your money to us actually paying it out is approximately about 15 days tops. So it's really, really good. Now, 5 of those days are actually waiting for the funds to settle, to come out of the market. So if you take those out of the equation and you take the day that you actually submit it's really quite a quick turnaround. I think one of the other points that's really important to our pension, and it kind of relates back to what you said, Chris, where, if you don't need it all, don't take it, or, take as little or as much as you need as and when you need it. There is no drawdown fee. So if you decide today that you want to take £5,000 out of your pot, you can request that via your client site. But if you then decide tomorrow, an unexpected bill comes in, or, the car breaks down, or whatever it may be, and you think, oh, I need a little bit extra, again, you can request another payment the following day, and we'll facilitate that for you. You could request one every day, and there'll be no charge for that, whereas some other providers will charge an hourly fee or a basic rate for every single drawdown request that they process on your behalf. So again, coming back to the TPI pension, in addition to the fact that it's got no annual fee on there, there's no drawdown costs for when you enter or anytime you want to take. It's a really, really great product.
I think that's fantastic. I mean, it's not advice, because we don't give advice on this podcast, but it's just a case of making people realise that you can instantly access your money, is what we're saying, at no cost. And if you don't need it, leave it in a tax efficient environment. Why would you put it? Amazes me how many people have cash ISAs as well. Because you've got a tax saving on something producing absolutely nothing, really. Yeah. So why would you do it? So if you've got it cash ISAs, I would suggest to everybody you talk to your advisor about it, because if you're looking at your retirement savings, they ain't going to help, really. So you might want to just reconsider where you've got them on that point. And GIAs, Phil, what's a GIA?
It's a general investment account, so it's not a wrapped product. Effectively, they're only used by those clients who've filled their allowances in that given year, whether it be in a pension or an ISA, and they have money left over. Typically, what we see happen is, if any money does go into a general investment account, is it's transferred to ISAs every year. Again, it's what we've been talking about all day, putting money in an effective tax wrapper as soon and as quickly as you can. So that's what a GIA is effectively. It's unwrapped money, but typically one tries to wrap it up.
Yes, indeed. Yeah. There's some songs about that, wrap it up.
Yeah, something like that.
Yeah, Regeneration.
It was another life.
Yeah, probably. Yeah, Thursday night at the staff Christmas summer party.
Yes.
Yeah. Interesting as well. And if you're a husband and a wife, you should look at how you invest together, really, I feel. I mean, this is something you need to take advice on. But the advice I would take myself is the fact that, having a wife, it's interesting that you might be having some beneficial tax benefits to moving money between each other, because you're invariably going to live off the same money when you retire. So, if you've got a pension pot that's getting towards the lifetime limit, which if you don't know what that is, consult your advisor, it might be prudent to start recycling it some across to your wife as we go ahead. So we've built the pot, and we've talked a little bit about, why would you really take money out that you don't need. There's another very important point why you wouldn't take money out of a pension pot, and it's to do with inheritance tax.
Yeah, that's right. If you can preserve as much wealth as possible in your pension, typically you don't have to pay inheritance tax on it upon your demise. You can leave it to your estate tax free, which is if you look at the inheritance tax limit and the amount of wealth that there is in the UK at the minute, I know that they added a primary residence aspect to it, but anybody who's saved for the long term, over a 20, 30, 40-year time frame, they will more than likely exceed their inheritance tax limit. So using all of these tools, using the pension wrapper for that, it's dynamite. You can't beat it in terms of inheritance tax planning, just so that your loved ones don't have to pay a tax that is ultimately unnecessary, because there's legitimate ways of bypassing that by using a government approved tax wrapper. It's the government pension law.
And the lifetime allowance is in the region of 1,070,000, I think, at the minute.
Yeah.
But don't forget, again, its husband has an allowance and your wife has an allowance too. So you can shield £2 million worth of your estate from the taxman. And he'll also, or she'll also, because I don't know if it's he or she, the taxman anymore, it's probably a tax
person.
Tax people.
can actually give you allowances on the way in, up to 45% as a booster, and allow you to keep 2 million of it out of his grappling hands when it comes to your demise, as Phil said. So good advice there again. Okay, we've talked about taking money out and how they should want to do it if they need to. Just if you need to take an income from your pension, Chris, what sort of respectable, safe, I mean, there's two angles to this. There's a rate you could withdraw from that if you're comfortable about depleting your whole pot, would effectively use all your money and you'd run out when you die. Or alternatively, you can live off the income of a significant amount in a pension pot. What's the sort of safe estimate in your own mind to think of about that?
Yeah, sure. So maybe if we take the second one first. So if we think about actually if you wanted to not touch the capital of your pension, but just to take the natural income from the pension overall. If you had an income portfolio, say for example one of our balanced or cautious income portfolios, the yield on that right now is around about 3.5%. Again, that would be without touching the capital.
Mm.
So you get that money, but then obviously, if you're willing to start to think about, I say potentially depleting your pension pot, because obviously you'll get the potential for capital growth on your capital as well. But that would be a way of not touching the pension with just taking natural income. I think to answer your first question, I probably answer it in a slightly different way, which is you really need to take what you need and you need to be sensible about that. I remember years ago in my kind of private client days of working as a fund manager, we'd have clients that would ask for very significant amounts of money per month, which were way out of line with the amount of investment that they had. And you'd have to have a very difficult conversation with them to say, actually, this is unrealistic. So for me, I think my first port of call there would be an advisor who can look at your cash flow, how much you actually need, how much you have in total, and then they can actually model that out overall just to give you an idea of what is the sort of maximum that you can take. I think the next thing that I'd say, though, is you don't have to take the maximum. One of the key themes that are coming out of this conversation today is that, you should really just try and take what you need and leave the excess invested. So for me, I don't want to sort of give a number and say, you could take, say, 5%, something like that. But on the other hand, I think take what you need, be realistic, and speak to an advisor as well, who'll be able to look at cash flow modelling to help you out there.
Yeah, no, that's good. That's wise counsel, like Chris.
It is.
Wise counsel from someone of your age. It's sort of, we're talking about that cash dragon. It's the last time I'll mention it because it gets a little bit boring. But cash is not a safety blanket. If you think of average life expectancy in the UK being sort of mid-80s now for both male and female, if we're talking 55 as you first sort of thought about retiring, that's 30 years. Now, even in inflation at the government's target of 2 to 2.5%, that would be very attritional on your money. That's per annum, by the way. It's not over 30 years. If at the minute, the inflation doesn't turn out to be transitory, about 5 and a bit, then you're going to run out of money. So cash will not help. You need to be in real assets or assets that are inflation linked. So just give us a quick précis of assets that can combat inflation, please.
Yeah, sure. So in a kind of inflationary environment, where do you want to be invested? Firstly, I would say you want to be invested multi-asset. But if we want to look at the kind of individual asset classes, equity is the key asset class that will outperform in an inflationary environment. The asset class that will probably struggle a little bit in an inflationary environment is kind of traditional bonds, so sovereign bonds, corporate bonds, and that's because they pay a coupon and obviously that's a fixed amount, and then that fixed amount is eroded by inflation overall. You can look at other real assets, so things such as like infrastructure, property. There's so many different ways that they're actually all available within the True Potential portfolio proposition that we have that will provide you with a better than inflation return. I think maybe we've kind of talked about sort of what you could do, but maybe just look back. If I think of the balanced portfolio, that's given a return since launch, so just under 6 years right now. That's given you a return of around about 8% per year after fund charges. Now, inflation's been lower than the 2%, but let's say inflation was the 2% target that the Bank of England have. I mean, you're getting significantly more than inflation there overall. So for me, it shows the importance of being invested. I think the problem with cash is that cash feels really nice. It's a great feeling looking at your bank balance and think, oh wow, I've got loads of money in the bank. But the reality is cash isn't going to allow you to retire early. You have to be invested. You have to take some sort of risk. You have to be invested into assets that will grow. Cash just won't grow. You've got interest rates now in the UK, 10 bips. They might go up to 20, maybe even up to 50, something like that. But, that's not going to help you. You've got inflation potentially leveling out at 2. You're still not going to get the return that you need. You have to be invested.
For me as well, I think if it's in the bank and it's in cash, I'm more likely to spend it.
Yeah, that's a good point. Yeah.
It's the only lady on the panel. That's exactly the answer we'd expect. Okay. To wrap up then, before we talk about the really interesting prospect of what we've all got to do this weekend, quick bullet points. It's not like, what's just a minute. It's quickly, Phil. Bullet points to give people some security about what we're seeing.
In terms of the topic today, looking back over my notes, start early. If you haven't started saving, let's crack on, because time is the biggest friend that you'll have at that. Set yourself a goal. Obviously, is what we talk about all the time here at True Potential. Goal-based investing is the most realistic way to invest for the future. Use a combination of lump sums and regular contributions, and use your allowances where you can, but you don't necessarily have to use them all at once. You can do them over the course of a year.
Yes.
It's slightly unfair this, Jenny, because Phil's just read all our key messages. But anything you could add to that?
Stay invested. Stay invested.
And I think you.
Well, my only one is just think about where you're invested, particularly when it comes to cash.
Brilliant. And I'm going last, so I can't add anything to that. But I can tell you that this weekend, it's the start of it's not the start, it's the second week of the Football League season. So I shall be at Bradford City's Valley Parade, watching Bradford play Oldham in a full crowd. There'll be a lot of people there. So
War of the Roses.
Mike and Audrey, who have sat behind me, for 30 odd years, I'm hoping to reacquaint myself with them after the lockdown. So I'm sure they're as happy and excited as I am. What are we doing this weekend, Jenny?
We're actually going to Kos on Sunday. So first holiday in nearly 2 years. So rather looking forward to that. So yeah,
fantastic.
Can't whinge.
We can't beat that now. We're all like, Phil, are you building tractors, or what are you doing this weekend?
It's actually more exciting than Jenny going to Cos. I'm painting a ceiling tomorrow in my living room, which I started to do last night, and I lost the will to live. So I'm saving all my energy to do that this weekend. So I can't wait, as you can tell by my duotone.
Are you going to give a colour tip to our viewers?
It's a mist coat, so you can use any colour you like for a mist coat, whatever you've got lying around. 50-50 split.
What will it end up as after the mist coat?
I believe we're going with calico.
Oh,
which is very safe.
Yes, calico, excellent. That's very exotic.
It is.
I don't think calico's got to Bradford yet.
No, I think calico is the 21st century magnolia.
Is it?
Yeah, it's essentially the same colour as far as I can tell.
Steel magnolia is great for Chris, what are you doing?
I'll be honest, I'm struggling to beat both Phil and Jenny here. I really am. I've just come back from holidays, so I think I'm going to have a nice quiet weekend. I may... If it's a nice day on Saturday, I may venture out to the pub for a bit of lunch. But other than that, nice and quiet.
Yeah, nice quiet liquid lunch.
You could go and help Phil. By the sounds of it.
I could.
Good.
Phil needs
Could.
it.
I definitely could, but I might not.
It's okay. I'll struggle on alone, Chris.
Well, that's brilliant. I hope you all enjoy your weekends. And Jen, we are very envious of you going off to Kos.
Yes.
To wrap up, everybody, there will be subtitles on this because I am conscious that there are several different accents today. And so for your help, there'll be subtitles. But can you go to our YouTube channels, etc., like and share if you will. But I wish you all a happy end to the week, and thanks for joining us today.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.